Welcome to everybody here at our Pandel Leadership Series. My name is Eliza. I am the Customer Engagement Specialist here at Pandel. And today we're really excited as we are talking about emissions accounting, turning compliance into capital. Now I am going to actually invite Dean up to do an introduction of our speakers today. Dean is a Senior Account Executive here at Pandel, and we're thrilled to have you here, Dean, to introduce our key speakers.
Thank you, Eliza. Thank you to everyone for attending today. Just a quick note on who Pandel is, if you don't know. So we're a leader in delivering web-based products and services to land, accounting, and operations departments to over 500 companies in Canada, the US, and abroad as well. Our customers range from startups to major enterprises throughout the energy sector, spanning industries of upstream oil and gas, midstream and pipelines, field services, land brokers, utilities, mining, and a lot of renewable energy companies coming to the mix now as well. Our focus at Pandel is really on innovation and customer service. So on to our presenters today. Peter Bryson, he's got over 35 years experience in the oil and gas industry, and he's currently the CEO of the Triac Group, Inc. He's worked in many sectors over those 35 years, gaining experience in accounting, production accounting, measurement, IT, and government regulatory programs, and we all know there's a lot of those. In 2016, after spending 20 years as an independent consultant, Peter co-founded the Triac Group, Inc. And they specialize in accounting, measurement, and governmental programs, providing those types of assistance to energy companies. Triac operates on a straightforward, professional, innovative, and quality-focused approach and continuously add value to its client and their assets. I personally worked with Peter at Harvest Operations. I found him to be very dialed into some of the production accounting and measurement challenges we had, and he's very focused on delivery. Your first speaker today is Mr. Corey Wood. Corey's got his Master's of Science in Renewable Energy and Resource Management at the University of South Wales. He's got 10 years experience in the environmental and regulatory as a compliance advisor with a focus on air emissions, quantification, reporting, and reduction strategies. In 2017, Corey co-founded and is currently CEO of Clarify. Clarify is an industry-leading cloud-based emissions management software. It integrates very nicely to some of the production accounting systems out there. So Clarify helps maintain and maximize tax savings, increase operational efficiencies, and helps identify opportunities to capitalize on carbon credit offset projects, as well as government funding opportunities. It's my extreme pleasure today, and you're going to find this very interesting, and it's my pleasure to introduce Peter Bryson and Corey Wood.
Fantastic. Thank you so much, Dean. Before Peter and I jump into the super exciting material here today, just want to take the opportunity to thank Pandel. We're very grateful to be able to speak to you folks today and present our material. Just going to take a very quick moment just to kind of talk briefly about the two companies and then jump immediately into the content today. So just to mirror sort of what Dean said, Clarify Inc. is a software company. We focus on providing industry-leading cloud-based solutions that focus around the automation of analytics and regulatory requirements all in one tool. So today we're going to be talking about some of the things that Clarify does to help out with some of these problems. The main goals there is the digitalization of an equipment inventory and being able to keep track of all the things that we require from a regulatory perspective, in order to then also enable fuel flare event and emissions quantification, compliance reporting across a broad suite of regulatory requirements, and really the value add there, the analytics and forecasting of emissions, carbon tax, fuel flare event, you name it. So very excited to talk about some of those things today.
Thanks, Corey. My name is Peter Bryson, and I am the CEO of Triac Group, Inc. And we're a small boutique consulting firm with senior people, and we believe, that we're accomplished and accurate and accountable in our fields, And that's our motto for Triac, and that's who we are. Thanks.
Thank you, Peter. If we can move on to the next slide.
With the emissions accounting and all the things that are being hit our industries, various industries, whether you're in oil and gas or, if you're a building manufacturer or a cement plant, it's about reducing emissions right now and being good for the environment. We believe that the approach to take is being compliant with the regulations and also ensuring that we're adding value to the products we're looking at. So if we look at this, diagram, it says reduce emissions to increase profit and grow. There's various different ways we're going to talk about doing that today. The increase of transparency in the communication, right? We believe kind of fundamentally that reducing emissions can create value to your bottom line and hence get your regulatory compliance. So, really it's about shifting the investment and regulatory landscapes, for oil and gas in particular, to try to get money into our business. We know that we've got to have good ESG reporting. Our investors that come into oil and gas, especially now in the last few years, they expect us to have pretty transparent emission accounting programs and, be in compliance, right? And we believe also that once we do this, it gives us the ability then to, create better business decisions. It kind of goes back to that. If you measure it, then you can understand what it's about, right? So there's tons of overlapping emission requirements right now that are coming into effect in the last 2 to 3 years, and we know they're going to change, right? So we want to make sure that we're on top of it and leading the way as an industry to try to maximize our profits and also minimize our costs while adding value to the environment. Oil and gas people that we know, they all want to do it better. And so this is giving us the opportunity to do that.
Thanks, Peter. So one of the things you've mentioned there certainly is the rate of regulatory change and the things that we've seen in the last few years. This slide certainly does not summarize all of that regulatory change, but we think that it does a good job of two things. One, showing kind of, it's a busy slide. It's definitely a busy industry and a busy area to work in when looking at regulatory compliance and the things that we have to do to achieve that ultimate goal of compliance. So we have put some little examples here kind of to show those changes, but also to show that each province and the federal government are really moving in the same direction. So while Peter and I were putting together the content for this material, we discussed quite a bit about the level and detail that we should talk about. Should we talk specifically about Alberta or perhaps about, Canada as a whole? I think this slide shows that it doesn't really matter who we talk about or what level of detail we go to, because whether we look at Alberta, British Columbia, Saskatchewan, or the federal government here in Canada, we see them all doing similar things, perhaps with a slightly different cover to the regulation, but ultimately the goals are the same. So as we go through this presentation, we're kind of keeping these things in mind, that these are definitely check boxes we're trying to check off, but also we should look at them in ways that, doing these things can provide a tremendous amount of value to our organization. So typically what we see, no matter what regulatory regime we're looking at, we're going to see definitions, changes to those definitions for fuel, flare, and vent from how we used to classify or categorize those activities. We're going to see a real push towards site and equipment specific limits, usually regarding venting. We're also going to see a focus on the idea of methane reduction or overall emission reduction, and how do we do that? Do we have targets set? Do we have a plan? Is that plan something that is achievable? So as we move through this, we're going to consider these things from a compliance perspective, but also try to work in, that even if these regulations weren't here, might I do these things anyways? And if I did, what type of value or what type of benefit would I get from it?
So the next slide here, we talk about specific to oil and gas, right? We know that typically if we produce greater than half a deca or half a E3M3 of fuel, or consume half E3M3 of fuel a day, we got to measure it, right? And typically we've had 1 meter at like a gas plant where we measure here, the 100 E3M3 of this fuel meter. What with the regulatory changes that Corey's talked about, the buckets that we allocate that fuel, flare, and vent into have changed, right? Under the old regimes, we used to report that 100 E3M3 just as fuel, and now with the changes in regulations, we have to break it out into vent and flare, right? So in this example here, we've said that 100 E3M3 feeds 90 E3M3 of fuel with the various different pieces of equipment underneath it, and then into vent, things like pneumatic pumps and pneumatic instruments now, where we used to classify them as fuel, are now classified as vent, and then into the flare bucket also. So, that 100 E3M3 now all of a sudden becomes 90 of fuel, 8 of vent, and 2 of flare, whereas before we used to just report it as 100 of fuel. And that becomes significant into the next slides that we'll continue to go through, where we look at the carbon pricing models that are on here.
Great. So shifting a little bit from kind of the regulatory change and the things that we've seen in the changes of the definitions and the equipment inventories, we've also been hit, maybe not the right word to use, but we also now face the concept of carbon pricing in Canada. So similar to how we saw regulatory change across the multiple different jurisdictions, whether it be provincial regulatory change or federal, we're seeing the same thing happen with carbon pricing. So if we look federally in Canada, we have what's called the Carbon Pricing Backstop, which is enabled by the Greenhouse Gas Pollution Pricing Act. So the federal government, back in around 2018, announced that carbon pricing is a mandatory thing in Canada. It's something that we have to do to be, responsible corporate citizens. We've got to have a price on our carbon emissions. So the federal carbon pricing backstop put in just that, a backstop stating that if your province does not have its own program, you will be subject to the federal carbon pricing program. The federal carbon pricing program has 2 elements, a carbon levy and an output-based pricing system. And typically you're in one or the other of those 2 programs. In response to the federal carbon pricing backstop, the Alberta government replaced the existing Carbon Competitiveness Incentive Regulation, or the CCIR, with what is called the TIER regulation, or Technology Innovation and Emissions Reduction Regulation. This is Alberta's new industrial greenhouse gas emission pricing program, which works on an output-based pricing standard. British Columbia has been really ahead of the game. Some might say that, Alberta's sort of been along with them, but we've gone through a bit more change than British Columbia has. BC has had their provincial carbon levy in place since 2008. It's fairly straightforward. It just simply puts a price on pollution by adding a tax, if you will, to fuel use in the province. Finally, also as a reaction to the federal carbon pricing backstop, we've seen the province of Saskatchewan put in some new regulations here in the last couple of years. They have an output-based pricing system similar to TIER, similar to that output-based pricing system under the federal government, called the Management and Reduction of Greenhouse Gases Regulation, or called the MRGHG. Again, this sets a benchmark. It basically allows a certain amount of emissions to be emitted with no penalty. But then once you get above that bar, you start to face compliance obligations or a reduction obligation. Saskatchewan's gone perhaps a little bit further than Alberta in the carbon pricing side, in that they also have costs associated to venting and flaring when those activities are performed above and beyond a benchmark. So again, we could talk about these different jurisdictions, but I think what we want to get across here is that it appears as if carbon pricing is here to stay. There does seem to be a couple different approaches to carbon pricing, some which may be good for your organization, or perhaps I should say better than the other approach. And it's worth being aware of exactly what your jurisdiction's doing and how they're going about that. So there's a lot on that last slide. So what we wanted to do here was kind of break down these two different approaches so that they're fairly clear as we move forward throughout the presentation. So we've talked about the concept of a carbon levy. British Columbia has the carbon levy, and there is a carbon levy component under the carbon pricing backstop federally. So a carbon levy is a pretty simple approach, really. We actually just add a tax to the amount of fuel that is consumed in a backstop jurisdiction. So that would be, in this case, in a province that has the carbon pricing backstop implemented from the federal government. So when we talk about fuels, we're talking about liquid fuels, gaseous fuels, as well as solid fuels. And we look at each different fuel type and consider the emissions that would come from combusting that fuel. And we put a price on it that's related to the CO2 emissions, again, from burning that fuel. So I have a few examples here. We are aware of the carbon levy rates that have been set up until 2022. We're showing the $40 per ton of CO2e pricing here and how that relates to the different fuel types in a cents per liter type tax. And we know that this is going to increase over time up to $50 per ton in 2022. And beyond that, there's been a bit of a goalpost set saying that the price will hit $170 per ton by 2030. As an alternative to the carbon levy, we see an output-based pricing system. Again, you're typically only regulated by one of these approaches. The output-based pricing system approach, which would be similar to TIER in Alberta or the MRGHG OBPS in Saskatchewan, if under this program, you're typically then eligible for an exemption from the carbon levy. And that's what I mean about being really just regulated by one of these. Under an output-based pricing system, we look at performance benchmarks. Typically, there's two different types of performance benchmarks. We often see a high performance benchmark, which is really related to a particular sector or a particular activity. And that benchmark usually comes from something like the top 10% of the performing or top 10 performing facilities or companies in that industry. And we set a bar based on their activity. So if you are within the top 10%, then typically you don't have a penalty or a compliance obligation. However, if your facility or company performs at a level that is lower than that 10%, then you're going to emit over the benchmark and have an obligation to face. The other type of performance benchmark is a facility-specific benchmark. People in Alberta will likely be more familiar with this facility-specific benchmark, which is just that, facility-specific. We're looking at one facility year over year, and we're coming up with a benchmark based on an average of historical behavior or historical performance. Under this type of approach, facilities are typically allowed to emit up to a yearly performance standard. That performance standard is in relation to your benchmark, and that performance standard then decreases year over year, forcing that company or facility to get better. Facilities that are emitting less than their performance standard will typically find themselves in a position to generate performance credits and not have to pay a penalty, not have to reduce. However, those facilities that emit greater than their performance standard typically have to satisfy a compliance obligation. In a lot of cases right now, that's usually some sort of penalty that has to be paid. So again, fairly, kind of simple concepts. However, they don't come across as simple when we have all that text on the screen. So if we were to really, really simplify it, we would look at something like this. Under the carbon levy, 100% of the fuel that's combusted and often also flared is taxable. So it's a pretty straightforward equation. We just look at how much was used, we multiply that by a tax rate, and we come up with a fuel charge. As an alternative, under the output-based pricing system, less than 100% of the fuel combusted and flared is taxable. How much less than 100% can differ based on those different benchmark types that we looked at, whether it be a high performing benchmark or a facility specific benchmark. But there's also often some other very kind of what may seem like minor details when reading the regulation. However, then when working through the math, we find out there's significant details, such as in Alberta, when we look at the tier regulation. When we move to the output-based pricing system, we will shelter somewhere often around 90% of fuel combusted, but also 100% of flare, because in that particular regulation, flare volumes are not considered within a benchmark or within a performance standard. Only fuel is. So we can see here that just by selecting, or getting into one program over the other, we may use the same amount of fuel, we may emit the same amount of emissions, but each program is going to result in a different cost to my company or to my facility. Peter, please feel free to add to that if you think I've overlooked anything there.
Yeah, no, I think the important fact is that typically what we're seeing, whether it's in Canada or other places, that when you go to the federally regulated cost structure is less than the state or the province cost structure. So you want to really look at the differences.
So a few years back, we used the Clarify software system to actually forecast different carbon tax obligations for one facility under these different programs to see how that one facility, if it remained constant, if we simply just moved it from one approach for carbon pricing to another, how those costs would change. I don't know that I really need to say a whole lot. I think this diagram does a pretty good job at showing that under the federal program, where we're paying a carbon levy on 100% of our fuel and flare, our costs were quite significant. They would be that red bolded line there. If we took that exact same facility and we put it as an aggregate facility into the tier program in Alberta, we see a drastic reduction, somewhere around 90%, of the compliance obligation that we would have in relation to carbon pricing. The final little orange line there is actually the previous provincial program that was in Alberta prior to the repeal of the provincial carbon levy under the new government regime. So again, just a picture here to show we do have carbon pricing. However, often there's the ability to determine which program best suits your company, your facility, and you can see here that there's drastic changes between those different approaches.
Corey, I'm going to jump in. There was a question, Robert, great question. He asked the question about what happens to flare in Alberta under tier. Robert, it becomes exempt when you're in tier. So you do not pay the carbon, and it's the carbon levy on your flare when you enter into tier.
Yeah, just to qualify that a bit, Peter, just to make sure it's clear, typically we are talking about an aggregate facility, so 100% correct there around the aggregate facility approach. It's probably worth, as we talk through this, considering that we are talking about an aggregate facility, even if we maybe not make that as clear as we should, things are slightly different for those facilities that emit greater than the large emitter threshold or are opted in as large emitters. In that case, the flare volume would be there, but typically we're talking to those smaller intermediate producers that find themselves within the aggregate side of tier. Great, so Peter did walk through this diagram earlier, and when we walked through this diagram, we were really talking about the new definitions of fuel, flare, and vent under the various different regulatory requirements across the provinces. So we know that we have to do this if, for example, we talk about Directive 60 in Alberta, we're going to need an equipment inventory, we're going to need to probably work bottom up to get ourselves to a position where we can break that 100 E3 M3 out into these three different buckets. But the nice thing about that is that if we have done this, we are in a much better position from a carbon tax perspective, as well as from a compliance perspective. Why is that? Because under these programs, typically what we're looking at is fuel combustion being the taxable portion of fuel use. Specifically in Alberta, we just talked about it, venting and flaring we see limits there in Directive 60 on how much we can vent, how much we can flare. But if we're an aggregate facility, we're not paying a cost on that. So if we go to the next slide, we'll see how companies that are doing this differ from companies that are not. So on the left-hand side of this table, we're just going to take that 100 E3M3, kind of the old way that we would report fuel. If we just reported that 100 E3M3 and used a simple approach to get to tons of CO2 equivalent, we're going to get somewhere around 250 tons. Paying the federal fuel charge, that's going to come out to be about $7,760 at $30 a ton for 2020. If we forecast that out to that $170 a ton of CO2 equivalent, we're up to almost $44,000 on the year in carbon tax. And this organization is paying on non-taxable fuel use. Again, that 100 E3M3 actually has about 10 E3M3 that's not taxable under some regulations. Further, this company doesn't really have the transparency behind that meter, behind that fuel use, to start looking at projects and things they might be able to do at the equipment level in order to further reduce that fuel number. As an alternative, if we consider that last diagram and we think of those companies that are breaking out their fuel use into fuel combusted, fuel vented, fuel flared, we instantly see a reduction in the amount of fuel combusted, down to 90. That, of course, will then translate into reductions under the federal fuel charge, should they be paying that. And this organization finds themselves in a better position to now reduce that moving forward. They're able to look at the equipment that's burning that fuel. They're able to consider the difference between rich burn engines and lean burn engines. They're able to look at projects that they might be able to do to their equipment in order to continue to reduce that fuel use and see that fuel use number come out in their production accounting before they submit it.
Triac first started getting into the emissions business. Like, we were pretty suited for it because we were in the measurement business already, and run EPAP programs and measurement specialists, and we've got some senior people in that area. And we started to look for kind of partners. Triac, we always say we're kind of system and company agnostic, and that we, whether it's Clarify or other emissions management systems, we will help implement those things. But we started to look at other partners, and we did some alignment with a company called Vertex, and they've got the kind of the field side of this thing. So if you look at the emissions management, kind of in the old days, as oil and gas companies, we had one person that looked after our emissions management for our company and did all our federal reporting and provincial reporting and things like that. Under the new regulations and things, and when they started to price the carbon, all of a sudden now we had to kind of expand our offering and move into different areas of our business with accounting and joint venture and agreements and operations and all those things being involved. With Directive 60 changes, and things like that, the regulatory and environmental and consulting and field services side, Vertex has given us a pretty a stable partner to work in, and we trust them, and that's, we've got other partners also, and then if you look at kind of the enhanced reporting and measurement services, we cover that off a little bit. And then with Clarify, the equipment, really what's happened here is that we got to inventory all our equipment, and then we have to have process changes to keep our inventory of equipment up to date, right? So we see it kind of as a pretty significant effort to run an emissions management program now. These next slides, accounting with purpose. Again, it goes back to, emissions reporting 10 or 15 years ago was different than it is today. Once we started to put a price on carbon and fuel, flare and vent, and just our ESG reporting and trying to attract investment into our business, we now all of a sudden have to get our whole company involved in this. And that's what we see, is trying to bring all different pieces of our company and understand, and I'm not talking Triac, Clarify, or Vertex, but the individual particular oil and gas companies or cement plants or whatever it is, try to understand the regulations so that we can transfer data and reduce redundancies of systems and things like that. So if you have one system, like we've got in oil and gas, we've got field data capture systems. We move our data from field data capture to an emission management system, then into production accounting, provincial reporting, and then over to our accounting systems. Looking to make sure that our systems are set up along the way. 1 equals 1 equals 1 in each system, right? And that when we go in and help companies manage their emission management software implementations, typically it's a lot about data cleanup. So, when you can look at the data cleanup early on now in your system cycle, then you can save yourself some time later. The automated the accounting and analytics, one of the things that we see why they're doing all this is that if you measure it, it goes back to that statement. If you measure something, then you can get better at it, right? This isn't going away, right? I talk to a lot of oil and gas presidents and things like that. And, we all want it to go away, but it's not going away. So it's kind of that lead follower, get out of the way kind of category, right? So we got to shift from the past and move into the future, right? The people on this call, a lot of you guys are instrumental in your accounting and your operations of your business, right? Start kind of taking it to your management and letting them know that it's here and it's not going away. It's going to cost us money, but we think that there's ways to reduce the money that for the cost to the business. Capitalize on compliance. What we see also at the federal level, whether it's in Canada or elsewhere, the administration typically is a little bit less. When you start getting into the provincial programs, then the administration becomes a little bit harder. So when you're opting into one of these programs, whether it's TIER, the Saskatchewan OPPS system, do your math on the cost also, right? Whether it's internal dollars and a brown cycle, brown dollar thing, or whether it's external dollars where you got to pay to a company like Triac or Vertex or Clarify. Do your math and make sure you're looking at the right numbers. The big thing I think for us as an industry, and whether it's oil and gas or cement or building manufacturers or outside industries, any manufacturing business really, is that we don't get to use our fuel flare and ventor. They're no longer free, right? So previously in Alberta and Saskatchewan or Western Canada, we used to be able to use our fuel for free, and we, part of our joint venture account said that we could use the fuel for free. That's no longer the case, right? It's costing us, whether you're in the TIER program or the federal program, right? On the federal program, if you do the math, it's 10.34 cents per liter. That equates to about $100 in E3M3. On a provincial basis, from the slides Corey showed you before, that's about $10. Don't quote me on that, but it's in that neighborhood. So it's no longer free, right? We used to only have the opportunity cost of using it. So it's something that we used in our manufacturing process and couldn't sell. But now there's not only the opportunity cost, but there's also the cost in the fuel charge itself. So the big thing that we tell people is make sure you have the volumes in the right buckets, right? So your fuel flare vent volumes. If you move E3, M3 out of your fuel, which is in the taxable category in the tier program or Saskatchewan, right? You save yourself $10, plus or minus, right? You multiply that by, 8,000 E3, M3 a month, you're talking significant volumes. Then the other side is, the governments have come out with a ton of programs to help us reduce our emissions. Like there's some programs out there where you can reduce your pneumatic devices from high bleed to low bleed, and there's inventory programs you can get money for, right? So understand those things, right? Like, and take advantage of them if you think they're valuable to you. These programs come with cost, right? There's administrative cost, and there's also the ability sometimes to give up your carbon credits, right? Carbon credits become valuable at some point in the future, right? So the ensure that strategic alliance to the carbon tax regimes, right? Understand what's going on and make sure that you're not duplicating payments, so that if you think you're in tier versus a federal carbon tax, make sure you're in the right program for you as a company. Do the analytics on it.
Peter, one more thing here. I think on this slide, my understanding, most of the attendees today, sort of accountants, financial accountants, production accountants, perhaps. Typically, we'd find ourselves at the end of the story. There'd be plans about reducing emissions in the field. The group would go out and implement those plans. The regulatory group would then quantify those emissions. And then at some point that data kind of gets to the financial accountant that has to pay the carbon tax. I would certainly suggest that those that find themselves in that position try to get themselves more towards the front of that story, more into chapter 1. Unfortunately, some of these things lead to the unfortunate circumstances where reducing my emissions, I can put in a project, I can reduce my emissions. If I'm not looking at it from a carbon tax perspective, I can actually do the right thing environmentally that then hits me in the pocketbook. So for example, I might reduce my flare volume by using that gas and using it to electrify something on my site. If I haven't looked at it from a regulatory perspective and really considered the carbon tax regime that I'm in, I might actually reduce my emissions, increase the efficiency of my organization, and also increase the carbon tax obligation that I have to pay. So I think what we're really trying to say here in a lot of these diagrams and certainly the emissions management sort of trifecta is that we can no longer operate in silos. We really have to sit at the table together as measurement, production accounting, regulatory, emissions, production accounting, and financial accounting, because we all have a piece of this puzzle now, and we all need to understand what's happening before we then move forward with a project. And so certainly this kind of detailed approach to accounting is what's required to be able to have an effective conversation about that.
Thanks, Corey. So the path forward, right? Accurate, transparent, reliable, your data. So make sure that your systems are in place, whether it's Clarify. There's people using Excel out there. Triac, we looked at a bunch of different kind of options, and we've partnered with various different software firms, and Corey and Clarify, we've implemented his systems at quite a few companies now. And what we always look for is making sure that the systems are set up so that they flow from, field data capture systems into Clarify and into production accounting. So we have a one-to-one relationship. The Alberta government, and this is specific to Alberta, but it's really Western Canada, are really looking to, there's different levels of reports we have to submit, whether it's in Petronex or One Stop, or now if you're in tier, you got to do that. So, and they have now the ability with the transparency of data across all government to be able to kind of cross-reference what you're reporting, right? I don't know if any of you guys have got the report card that AER published, but that's about reporting 1 in one system and 2 in another system. And so they're checking us on that stuff. So make sure that whatever you're using as your boss system transfers into the other systems, right? So that talks about point 2, right? Integrate. And then it's not only about the emissions management system, but set it up so that when you push your volumes into your production accounting systems, that they're mapped correctly. And then furthermore, when you start doing the accounting and putting value on fuel, make sure that your systems like Pendel are set up so that it's, your transfer of data is pretty easy. So, if in Pendel you use a cost center, make sure the cost center is set up in your system. Or if it's a UWI cross-reference, make sure you do that, right? So that you can, do push button kind of, processes. The other side that we typically, what we recommend people to do is we push from the field data capture system into the production or into a system like Clarify, then into production accounting, and then through the financial accounting software. There's a different path on that too. You can go from field data capture system into an emissions management system like Clarify, and then back into the field data capture system, and then push out to production accounting. But we've seen the step processes from field data capture into an emissions management system and then out. One of the other areas in part of our business is, the review and update your agreements, right? This is not a tax, right? It's a charge. So there's a little bit of nuances of differences, but we think that from what so far we're seeing, and we're not high-level tax accountants, but so far from what we're seeing, it's deductible from an income tax point of view, right? And it's chargeable to the joint account. So, and the costs associated with it are chargeable to the joint account, we think. So PASC has if you're a member of PASC, they've published a couple of papers on it, and I know that PJVA is looking at this also. So make sure your agreements are updated, right? Back 10 or 15, it was probably about 10 years ago, we saw an agreement where somebody had put in that the operating company owned all the carbon credits. And that wasn't even on our radar back then, right? So understand what it means, the words in your agreements. The other side is, we're, as oil and gas, we're coming into a lot of asset acquisitions and dispositions, right? And so make sure that you are understanding the implication of the fuel charges at the various jurisdictions. When you're doing your final statement of adjustment, there should be, like under tier in Alberta, for example, the owner at December 31st is responsible for the whole year. So if you buy something mid-year, you got an adjustment to your FSOA. So things like that. So start really looking at the big picture and putting in clauses to those types of agreements, right? The other question then becomes tiers and annual programs. So at June 30th here, coming up, we're going to have a bill as an industry, right? We've seen bills in some of the companies we manage up to $750,000. So not insignificant amounts of money. At a federal level, if they were in the federal program, that'd be 7.5 million. So, again, saving costs and things like that. But, should we be booking that on a monthly basis, or, do we do it as an annual cost? So things like that we have to start considering from an accounting point of view. Are we going to be the bankers as operators for carbon tax? That's a choice that your individual company probably has to make, and things, the organizations we see have to get into. So in the last kind of point here is, there's a lot of talk about carbon credits and things like that, and you'll keep carbon credits on your books potentially. They become an asset to your company. So, when do you sell them? When do you keep them? Right? It almost becomes a commodity trading things, just like we're selling natural gas, right? If you're if you're hedging oil. Well, so there's going to be implications on your financial statements and how do you record that stuff. So, the path forward for us as individual companies, like the big companies, they've got a lot of people, right? So the smaller guys, we have to pay attention to this. So monitor your regulatory changes, right? Ensure your representative are watching closely. There's tons of emails you can sign up to, like the AEP's got an email, the AER's got emails, things like that. Join committees or industry groups and stay engaged, right? So don't be silent on this stuff. And if you're in a jurisdiction that doesn't have it, get involved. If there's not a group that represents your company size, create one, right? This is the value to your company. So, don't be silent. And then the other thing that we'd say is on the carbon tax side of things, start to educate your company and include in your day-to-day discussions, right? And make sure that you're engaging your company so that people are aware of what's coming. So that's all we have.
That was wonderful. Thank you so much, Peter and Corey. I'm going to dive right into questions, starting with where do the carbon credits come from and how do you attach a value to them?
I can take that one and start anyways, Peter, and then you're welcome to fill in my gaps. So it's, we think of it like a cap and trade system, carbon credits. So it's typically someone that is in a compliance position or someone that, so for example, if we talk about TIER, those companies that emit over their performance benchmark have a penalty to pay. And we always usually just talk about it like you send a check in to the government. And honestly, that's what you're going to do. However, what the government does with that check is create credits that become available in this fund. And then those companies that are in a position to receive credits can now get that from that fund. So you can think about it like the bad emitters, they create the carbon credits that are then available for the good emitters to grab or to buy. Another way, that's typically called a performance credit, an emissions performance credit. There's also what we call offset credits. And so offset credits are generated by those companies that are out doing voluntary actions to reduce their emissions. Peter's already touched on one of those offset type protocols for pneumatic instruments. So if your company goes out and replaces your high bleed pneumatic instruments with either low bleed or no bleed, that action is voluntary until January 1st, 2023, at which point you then have to do that. But if you were to do that before that date, then that's a voluntary action that offsets carbon, offsets emissions, and therefore you get rewarded through the generation of carbon credits that you then have to sell, trade, or put towards perhaps a future compliance obligation that you have in another area.
Excellent. We'll hop right on to the next one then. Can you recommend any courses for someone who wants to learn more about this entire process of this carbon tax issue?
I don't know if there's any out there. We've just been reading regulations. If you want to learn more, reach out to me and my email's there and we can have a chat. I don't know everything, but, and that's the big thing is this is such a diverse area. I don't think anybody really knows everything. So reach out and we'll put you in touch with people that we think can help you.
Good point. Okay, thank you. How do you see emissions accounting in terms of addressing other types of pollutants? Are industries starting to ask about managing all type of pollutants throughout their operations and supply chain?
I had a discussion with a CFO about, I don't know, it was probably a month ago. And I said to him, within 5 years, you'll have 3 people and you'll call them emission accountants in your company. It's an expanding area. There's no question about it. The ESG reporting that we're going to be under over the next, there's tons of changes on that side also. And it's going to affect our way of life and how we operate in our business. And if it's not there yet, it'll be there in the future, I think. And Corey, I don't know if you'd have anything to add on that.
No, I think that's great. I think from, right now we're only seeing carbon pricing, so attached to greenhouse gas emissions, those which have the global warming effect. However, there's still stringent requirements around reporting air pollutants, sort of the cousin to greenhouse gas emissions, if you will, those which pollute the air and cause smog and all those types of issues. So I personally am not seeing a cost yet on NOx emissions, for example, but NOx emissions are very well regulated and have lots of reporting requirements and limits around them. So ensuring that you're accounting for them and understand them correctly and confidently is certainly something that will provide value moving forward.
Okay, great. Okay, moving on. With all these systems feeding in, does this help avoid duplication on input by each group and help with consistency across data?
Yeah, I think I can quickly say something, but then pass it over to Peter because I think he'll have more than I do. Certainly from the Clarify perspective, we're very excited to see the reduction in administrative time spent month to month moving this data around. So for example, production accounting cycles, we typically see them anywhere between maybe 10 to 20 days in a month, depending on what your current process is. And we're seeing after full implementation of the Clarify product integrated with the two systems, that time frame's cut to at least half. We're seeing even better reductions there. And does that reduce the amount of work that those folks do in a month? No, I wouldn't suggest that. But what I would say is that it leaves them with more time to do the things that provide more value. So it's within those days that our users are using Clarify to find meter discrepancies, issues within their accounting system that was duplicating meters and resulting in the over-reporting of fuel, which would then result in the over-reporting of a compliance obligation or a carbon cost. So absolutely, I do think that this approach of getting these systems to integrate together, it may not reduce the amount of people we need or the amount of time we need to spend, but I do think that it turns that time into more value for us, for sure.
I think the only thing that I would add is understand what your book of record is. What's your boss system in the thing, and where do your boss relationships in your systems, reside? Once you understand that, then you can create checks and balances to ensure that what you have in your system is reported to the government. That'll save you time, right? Because of the multi approaches on where we got to report. So, and we know the governments are looking across the public data, right? Now you can get Petronex data for the whole industry, right, in Alberta.
Okay, thank you. Let's keep going then. Are credits issued on volumes or on dollars?
The third option, actually, C, typically mass. So we would typically look at tons of CO2 equivalent to determine the number of credits. So typically 1 credit equals 1 ton.
Okay, excellent. That was a good one. And then how can a company use the carbon credits it creates? For example, can you sell excess credits if there's such a thing to other companies?
Absolutely, yeah. So there's typically you can use those credits and put them towards future compliance obligations. We see varying different rules, but sometimes around 60%. So instead of paying your obligation, you can account for that 60% of that obligation with credits that either you have generated, you have bought from someone else that they had, or maybe you've traded in some way to get those carbon credits. We also see lots of strategies around carbon credits. We talked about the cost of carbon is going up every year. So a credit that's generated this year is worth, maybe $40. By the time we get to 2030, that might be $170 for that credit. So, we see people just investing in them like they're stocks. I don't necessarily work with those people, but I hear those stories.
All right, moving on. Can companies choose a program to be in? Is there a deadline to choose? Are you in the federal program until you choose to be in the provincial program? And how would you change that?
I'll tackle that. Yes, you're in the federal program until you opt into a provincial program. Saskatchewan's got the output-based system that you can now opt into if you're under 10,000 tons, and you have to make the statement to opt into it. Alberta's got tier. And you can opt into that also. The deadline to opt in for 2021 was December of 2020, but you can still opt in, but on a portion basis. So you can still get into tier, but understand your costs. And if you have further questions, reach out.
Yeah, I would just say to that, that's a very important question, because the unfortunate truth is that there are companies right now that are racking up federal fuel charge bills that don't really know that they're racking up federal fuel charge bills, and they need to make a decision as soon as they can to get out of that position and get into one of these output-based pricing systems to stop that bill from climbing.
Okay.
Yeah, Eliza, as a follow-up, good point, Corey. We work with various different companies, but we had a company that's pay $100,000 in federal carbon tax, and because it's on flare and fuel, and they'll pay $2,500 in the provincial.
Okay, yeah, that's pretty significant.
Big money.
Yeah. Okay, and it's kind of on the topic of costs. This sort of connects. We have a question about, so with regards to the cost of implementing and maintaining the ability to better track your carbon emissions, do you know if there are any provincial or federal grants available besides carbon credits to help implement new technologies?
All I can say is that yes, there's a lot of them right now. I'm no expert in them, so I'm aware that they are there, and I typically, pass those questions on to colleagues that do specialize in those funding programs. But I mean, now's the time to definitely look at what's available and get in touch with those folks that are working with applications and things like that.
Great. And then we'll just move on to the last question that we have time for today. Are carbon credits company-based or facility-based?
I think I'm going to go ahead and answer that question and say it's company-based. The way that I'm understanding the question, perhaps, if I generate a credit over at this facility that I own, can I then use that credit to reduce my obligation for this other facility that I own? And the answer is yes. So typically it's there's a company that owns the credit. And it's not just specific to one facility that they have.
Okay, thank you, guys. That was so much wonderful, useful information. And Corey and Peter, thank you so much for your time, for your expertise. I know it was highly valued. The chat is lighting up with positive feedback. So thank you so much for that.
Eliza,
right.
thanks to Pendel, and thanks for hosting us, Eliza. That was great.
Our pleasure. Okay, everyone, thanks again for joining us today. Have a wonderful afternoon, and we'll hope to see you next time.
Thank you.
Bye.
Thanks.